I'm Caroline Hyde. This is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up, Snap pitching a stock to investors that's more expensive and comes with less shareholder control than any social media company before it. We'll dig into the details. Plus, a new deal for Yahoo. We'll preview the offer that could finally end its long dance with Verizon. And Apple reaching new highs. What's behind the surge, and can it sustain? First to our lead. Potential investors are scrutinizing Snap's financials after it set the terms of its IPO. According to the filing, the maker of Snapchat is offering 200 million shares for $14 to $16 each. At the top end of the range, Snap would have a market value of $18.5 billion. That means Snap co-founders Evan Spiegel and Bobby Murphy could each take home a check of as much as $256 million. Now, we spoke with David Kirkpatrick, CEO of Techonomy, and Bloomberg TV editor-at-large Corey Johnson for more.
What becomes of this, I don't know. I mean, it's a certainly high valuation. On the positive side, they've got some big growth numbers on year-over-year basis. We all know the story of sort of who they're reaching and how hard those consumers are to reach and how valuable they are to advertisers. But this is an extraordinarily high price for any company of any kind with any kind of growth metrics. But for one that has negative gross margins, for one where growth is slowing so much, where there are some big questions raised. Look, this roadshow is going to be an interesting one because there's going to be excitement around the deal, but there are some very strange things in the filing, not least of which a very unsteady growth rate. There was one quarter on a sequential basis about the first quarter of this year, first quarter of last year, had only 14% growth sequentially, and then they turned that around. So what happened there? How does the business work? These are the things that are going to come up on that roadshow.
Yeah, David, what do you think? How much is riding not only on Snap and its founders and how much they get to take home and put in the bank, but how much is riding for the rest of the tech community on how successful this IPO? They've got to get the price right.
Well, it's one of the biggest IPOs in memory in recent years, certainly, and I think the industry is watching this with fascination because this company does sort of rise above the rest right now in that it is at least sometimes and more or less legitimately compared to companies like Facebook, Google, and Twitter. Obviously, it's way smaller, but it has that seeming potential to really be a fundamentally new kind of communication, given the passion that young people have developed for it. So I think it does sort of symbolize what some people think is the next phase of technology, driven heavily by video. On the other hand, it also, for me, symbolizes a kind of distorted financial mindset where they're not giving the shareholders any power whatsoever.
Yeah.
The idea that Facebook pioneered of creating two classes of stock has been taken to an extreme, and now every tech company seems to think that the founders ought to have essentially complete control, which is what literally they have here. So I think that's something the industry's watching with some ambivalence, frankly.
Yeah, Corey, this lack of voting rights, it seems to be, according to the own filing of Snap, that it's the first US company to really level this, to have absolutely no voting rights whatsoever when going to IPO. Is that why do you think they're being a little bit more cautious with the price tag, the overall valuation of the company?
The company is worth less money to shareholders for a lot of reasons. The company is worth less money for shareholders when it doesn't have gross profits. The company is worth less money to shareholders when it doesn't have profits, when it doesn't have free cash flow, when it doesn't let the voters, the owners of those shares exert their rights. So there are a lot of things that Snapchat is doing that's going to give it a lower valuation than it would otherwise get. But whether it's beyond the pale, it's hard to say. I mean, not having voting rights doesn't bother anyone when a company's run as well as Facebook. Sure bothers them when they're looking at companies like Groupon, where you've got multiple classes of shares. Doesn't bother them with Berkshire Hathaway when you've got an A and B shares with lower voting rights. But it sure would have bothered them at Yahoo when investors had to come in and save that company from itself, which is what happened. And so we've seen over and over again when companies face plant, outside investors can come in and make the situation better and say, we are the owners of this company. We can make this thing better. That will never, ever happen for Snapchat.
David, you're a man who knows the inner workings of Facebook and Mark Zuckerberg well, and even as we see perhaps Snap take a leaf out of Mark Zuckerberg's book in terms of voter control, we're also seeing, though, Facebook again and again trying to copy what Snapchat has been doing. Is the competition that fierce? Can Snapchat really change the way in which the world works, or will just Facebook end up dining out on it?
Well, I don't really think Facebook is primarily copying Snapchat. I do think there are product features that Facebook has borrowed from Snap, no question, and that's been even acknowledged by Instagram and others. So, but, you know, I really think the comparison between the two companies only goes so far. I mean, Facebook, when it went public, clearly had the potential to become a world-altering service that was used by almost literally everyone. Unless you believe that's true of Snapchat, you know, you almost can't justify this kind of evaluation, as Corey's pointing out. And I frankly don't think you can justify that kind of talk about Snapchat. It does not have, in my opinion, in its current design, the potential appeal to our parents, our, you know, children of all ages, you know, ordinary working people. It just doesn't have that kind of capability. So it's not a true comparison.
And next up for Snap is the Roadshow, where management will travel to cities including Los Angeles, San Francisco and New York to pitch the stock to prospective investors. Bloomberg's Sarah Farrar and Alex Barinka report.
When deciding whether or not to put money into Snap, investors are inevitably going to compare the company to its peers, Twitter and Facebook.
So which is Snap hoping you'll equate them to? Well, neither. My sources tell me that Snap execs want you to think of them more like Amazon. Seems strange? Well, there's a method to the madness.
Because Snap is such a secretive company, investors will have to decide whether they trust management to build a business on the backs of highly engaged young users.
For now, it's unclear what that will look like outside of the Snapchat app and its spectacles.
While the company grows and expands, management has told its bankers that financial performance could be, quote, lumpy. And don't forget that Snap's revenue model is only a couple years old, and right now, losses are higher than sales.
Sound familiar? Razor-thin margins and fluctuating financial performance are Amazon trademarks.
CEO Jeff Bezos has alarmed investors with his massive spending to get into new markets. Some of his efforts have been successful, like Amazon's e-commerce platform or its cloud services, while others have been duds, like its Fire smartphone. The bottom line is Amazon investors have had to be patient, and in the long run, it's really paid off. The stock is up 43,000% since the company went public in 1997, and in the past 10 years, it's up 2,100%.
But Amazon is a once-in-a-decade consumer internet company, and Snap is a much younger and much riskier bet. For now, Snap CEO Evan Spiegel is going to be left asking potential shareholders to trust him.
Coming up, Verizon is close to a renegotiated deal with Yahoo with a cheaper price after the revelation of security breaches. But the surprise, just how little that discount is. We'll break down the tentative deal next. And later this hour, we'll hear more from the man credited for the payment app beloved by millennials, Venmo. PayPal COO Bill Reddy joins us from the Goldman Sachs Technology and Internet Conference. This is Bloomberg. Verizon will begin offering unlimited data. The company will charge $80 a month for the single user. That's $10 higher than the plan offered by T-Mobile, which ushered in the industry's move to unlimited data last year. It's an about-face for the biggest wireless provider in the US, which had steadfastly refused to offer unlimited data plans. Meantime, Verizon is getting close to a renegotiated deal for Yahoo's internet properties. The new deal, announced this week, would reduce the price of the original $4.8 billion deal by about $250 million. Verizon had balked at the first price after Yahoo reported massive data breaches. Now, both companies are expected to share ongoing legal responsibilities related to the hack. Bloomberg's Alex Sherman joined us with more.
Yahoo's shareholders are going to walk away from this fairly happy because, look, there was a risk that Verizon might walk away from the entire deal altogether. And the game that's been going on over the past few months has really been who has more to lose here. And I think Yahoo has more to lose. If Yahoo didn't get the sale done, they would have been in a very difficult position. They would probably have to rerun that sales auction that people may remember took months and months and months, and they probably would not have gotten as high of a price because Verizon was the obvious buyer here with the most synergies to offer. So I think Yahoo's got to walk away from this saying, you know what, given everything that we know, we're pretty happy with only a discount of $250 million. That number may change, could go up a little bit, but it's going to be in that ballpark from what we hear.
Alex, I actually spoke to the CEO of AOL, Tim Armstrong, just last week, and it did seem that the desire was really there to get their hands on Yahoo and its consumers. Have a just quick listen to what he said last week.
I'm hopeful the deal closes. I think we really have a high appreciation for Yahoo overall. We just need to figure out whether or not there's been value changes, based on the breaches. That's really how simple it is.
The value change has clearly been negotiated now. What about the next steps for both Altaba, that is left out of the Yahoo business, and indeed where Verizon pushes now with Yahoo consumers?
Right, so you got the reason just there from Tim Armstrong about why Verizon was willing to accept such a low discount there. They want Yahoo and feel like they can put AOL and Yahoo together, and part of why they want Yahoo is so they can move on to whatever else is next for Verizon. We've already reported that there was a conversation between Verizon CEO Lowell McAdam and Liberty Media CEO Greg Maffei potentially about doing a massive deal for Charter Communications. We don't know if that's going to happen. It was very preliminary, but we do know that Verizon is looking at 10 to 12 acquisitions of size after Yahoo. So getting this deal done allows them to move on to whatever else is next, and you'd have to think that there's a very high likelihood that that could be a much bigger deal than Yahoo. On the other side, really Yahoo's internet business is only a small fraction of the larger now Altaba company, as you mentioned, which is Yahoo Japan and Alibaba. So from Yahoo's standpoint, they too are sort of willing to accept a discounted price here, not only to finally get a buyer for their property, but also so that they can monetize Yahoo Japan and Alibaba, which is really the crux of Yahoo. And now that's what they need to figure out. Is someone going to buy this stuff from them? Is it going to be SoftBank? Is it going to be Alibaba? Are they going to trade for a while as a stub? All those are still outstanding questions.
Alex, you're a busy man, and I therefore want to make the most of you while you're on this show, because you're not only putting out stories about Yahoo and Verizon, but also on Apple. We're talking deals there, and maybe lack thereof deals when it comes to Apple.
Right, so, Apple has this enormous cash pile, hundreds of millions of dollars. And Tim Cook, their CEO, has actually signaled over the past, let's say, 12 to 18 months that Apple may be finally willing to do some bigger deals. They've never really done deals in the 40-plus year history of the company. They've really just grown products organically, shying away from M&A. But Tim Cook's comments made sort of the investment world think, okay, well, they're going to get ready to do something big. We haven't seen it. So my colleague Alex Webb and I sort of dug deep into that and figured out, well, why haven't they done this? And part of the reason they haven't is that they're just not really structured to do big deals as a company. They don't have a very big M&A team. They have no history of doing big deals. They don't like working with investment bankers. So sort of the mechanics of being able to do a deal isn't easily there for them. Not to say that they won't, but I do think that the investment community has sort of scratched their heads and said, okay, look, you've told us you want to do bigger deals, so why haven't we seen it? And part of it may be that their corporate culture just really isn't structured to do this, unlike, say, an AT&T, which we have seen buy DirecTV and Time Warner. They've spent, hundreds of billions of dollars on acquisitions.
Bloomberg's Alex Sherman there. Meantime, this week, Apple hit a record high. Investors are optimistic the next iPhone will drive a resurgence in sales and help the company's services business grow. Bloomberg technology reporter Alex Webb joined us to lay out what's behind the stock surge.
As much as the stock is at a record high, they are interestingly not at the record market capitalization. Because of the buybacks they've done in recent years to help prop up that stock price, they're actually a little bit below that peak market cap, but the stock is at the highest ever.
I mean, market cap closing at 699.31 billion, so he's tentatively so close to $700 billion. Is it just the market rising, Alex? Is there exuberance about Apple's own business model at the moment?
Well, it did take a bit of a boost after the earnings call of the other week and the expectations for the next iPhone sales. But since then, it has broadly been tracking the market. So it took a little bit of a fillip 2 weeks ago, and since then, the forecasts for the present quarter and how that could imply that sales will go for the next iPhone have kept people very optimistic.
I mean, if I'm digging into analyst recommendations on Apple at the moment, we've still only got one sell, 41 buys on this particular stock, Alex. Are we likely to see the stock rally continue?
That's certainly the implication of those stats, yes. But interestingly, we are kind of getting very close now to the target price. It's not vastly above where it is now. I think it was at about 142 is the average that we have on the system. So it'll be interesting to see how, particularly by the end of the year, that will be the real clincher, to see how compelling the next iPhone is, how they succeed in attracting new customers, particularly in Asia and China, and that will speak to the attractiveness of Apple as a brand. We've seen that the competitors in Asia have increasingly succeeded in developing phones which are as good as the iPhone or approaching the quality of an iPhone, but they don't have the kind of brand cachet that Apple has, and it's the extent to which that remains a differentiator, that sort of shininess that Apple has about it and attractiveness as a brand.
And how much they can get bang for their buck from their user base. They say they've got more than 1 billion pieces of equipment. It's all about the services sector as well.
That is increasingly the narrative that the executive team at Apple is trying to push. They say that they intend to double their services revenue over the next 4 years. That's in fact through to 2021. And the average revenue per user is something that is a statistic that people are increasingly keen to look at. It is, of course, a higher margin business selling people's services. You don't have to invest in the hardware. Software is infinitely replicable, and that's why Apple is pushing into things like Apple Music, and it's made steps into television content, as well as, of course, the App Store, which develops, which sells a huge number of products every year, and Apple gets a cut of that.
That was Bloomberg's Alex Webb. Coming up, Wall Street meets Silicon Valley at the Goldman Sachs Technology Conference. Highlights from our exclusive interview with Goldman Sachs President and Co-Chief Operating Officer David Solomon. Next, this is Bloomberg. A story we're watching. Commuters in India faced major travel disruptions this week. Both ride-hailing giants, Uber and Ola, have been in disputes with drivers, bringing India's biggest cities to standstills. Drivers have been on strike demanding better pay and working conditions. Demands include a revision to the minimum fares, bringing back bonuses, reducing the commission rates, and limiting the number of cabs registered on the apps. Meanwhile, staying with Uber, Bloomberg was first to report on a little-known option available to Uber's earliest employees. The $69 billion company is said to have a program that lets those who've worked at the company at least 4 years sell back as much as 10% of their Uber shares. This, according to people familiar with the matter, who said that the plan caps buybacks at well below $10 million per employee. But it's meant to give Uber employees an incentive to stay, since the company has no initial public offering in sight. Well, this week we were live from the Goldman Sachs Technology and Internet Conference in San Francisco, where a number of the nation's top bankers and investors converge with Silicon Valley's tech titans. Deals like Cisco and AppDynamics, as well as Verizon's and Yahoo deal, well, they're ushering in an aggressive era of tech M&A. Wednesday, we spoke with David Solomon, Goldman Sachs Co-Chief Operating Officer, about the rising number of tech deals and, well, IPO activity in this space at the Goldman Sachs Technology Conference.
There is certainly lots of capital available for companies that are growing, and obviously tech companies growing, there's a good amount of capital available. A lot of that capital is available privately, away from the public market. Last year certainly was a historically low year in terms of IPO activity, and I'm a big believer that these things kind of ebb and flow, but ultimately gravitate back to mean. So, we're hopeful and optimistic that we're going to see more IPO activity this year. But I think when you look at the world that a lot of these companies operate in, if they're able to run their businesses and they're able to grow and they're able to access capital privately, and there aren't other pressures from shareholders or venture capitalists, these companies are putting off the opportunity to come to the public markets longer. And the reason they can is because the capital for growth is available privately. So I would expect to see more companies coming back to the public markets than we saw last year, but I think that process is going to continue to be, a very thoughtful, methodical process for a lot of these companies as they're growing.
As you say, ebb and flow. We saw plenty of consolidation in M&A, perhaps while the cash balances were heavy. we might see yet more cash come if we see money come from abroad back into the United States. You expecting consolidation, M&A, to be high for 2017?
Well, M&A activity, especially in the tech space, is pretty active right now. In fact, we've been involved in, I think, 14 M&A transactions in the TMT space since the first of the year.
Yeah.
And that in that 6-week period, I think that's more than we've seen in a comparable 6-week period. I think you'd have to go back to the year 2000 or the late 90s to see that kind of activity around TMT-related activity. I think there are a number of reasons why that's occurring. One of the things that's definitely happening here is you've got a number of very, very large companies that are growing very, very quickly. Facebook last year grew over 50% on a $28 billion revenue base. Amazon grew, I think, 27% on a $130 billion revenue base. As those companies are growing, they're generating cash, they're generating market cap, but they're also taking away revenues in some way from some other businesses. They're disrupting to some degree. And that puts some of these other businesses in a place where they've got to think about their strategic options more carefully. So I think, broadly speaking, we're going to continue to see consolidation in the tech space. And, I think activity levels will continue to be high this year. If the environment stays, the way it is now, I think it could be a relatively good M&A year in the TMT space.
Let's talk about disruption. Let's talk about fintech and potentially how Goldman Sachs itself is evolving. Lloyd Blankfein himself said, back in 2015 on a podcast, Goldman Sachs is a technology company. How are you adapting? Are you having to hire far more technologists, far more engineers rather than bankers at the moment?
We clearly, like everyone, are using technology in our business much more than we would have 10, 15 years ago. You can look, it's very easy to go back and look at the equity trading business. If you go back 15 years, the way people traded equities was voice to voice, person to person. And now, obviously, through a vast system of connectivity, people trade equities, generally speaking, electronically. And so that's a massive shift, obviously, in the staff that you need, the people that you need, the systems you need, the support that you need. That's going on in most aspects of the business. The firm itself obviously adapts to those environments, and we hire all different kinds of people. We have a very, very diverse workforce, and we obviously need different kinds of talent. We have increased the number of STEM graduates that we're hiring because obviously there's more engineering work, more coding work, and as we look to make technology investments that can really lever our ability to serve our clients, we need more of those kinds of people. I wouldn't say it's more of those people versus finance majors or other people that come from more of a business background, but it's a diverse group of people that put us in the best position to service our clients. And as you and I discussed before we came on, the quality of our people and our ability to attract great people to really differentiate the firm is really, really important to our overall business.
You helped drive a lot of innovation back in the investment banking unit. Does your culture have to change to attract these people in? Do they want more parental leave? Do they want more holiday? Do they want more flexible working?
I don't think it's fundamentally different. Young people today coming into the workforce want to work for a great organization with terrific people that serves clients, has business purpose, gives them the opportunity to learn, grow, and really excel. And so we've always been focused on creating the best work environment for long-term growth, positive experience, economic reward, for our employees. We believe if we do that, it's good for our shareholders, it's good for our clients, and it's a very positive cycle for Goldman Sachs.
You've got into digital lending. We've got Marcus, which is servicing the consumer base. How is growth there?
That's a new business for us and a new platform that we've started. We think we're in an interesting position. We're given our balance sheet and our funding, but without the legacy history that a number of the other commercial banking competitors have, that we're in a position where we can deliver a really tailored technology product to clients. We have a very targeted universe that we're going after. We think we've got an interesting product, and we're excited about the growth opportunity in that business. But it's new, but so far, it's off to a good start, and we're excited about the opportunity that's presenting.
My conversation with Goldman Sachs Co-Chief Operating Officer David Solomon. Still to come, former NSA chief turned CEO, General Keith Alexander, joins us to discuss the new administration's approach to cybersecurity. Next. And if you like Bloomberg News, check us out on the radio. You can now listen on the Bloomberg Radio app, Bloomberg.com, and in the US on Sirius XM. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Caroline Hyde. The US officials are investigating the extent of contact between President Trump's advisors and Russian intelligence agents in the lead up to the 2016 election. This after Trump's newly appointed national security advisor, Michael Flynn, stepped down this week. The developments are just the latest example of national concern about Russia's cyber capabilities and influence on US national security. Now, we spoke with retired four-star general and former director of the NSA, Keith Alexander. He's now at the helm of IronNet Cybersecurity and in town for the industry's RSA conference.
One of the things, I don't want to get out in front of the president, having seen the executive order and what they're doing on it. I think what he gave to the press there about addressing government, aggressively getting their IT infrastructure ready, about getting government and industry to work together and addressing some of the key problems, I think those are all in the right venue and what our nation needs to get started on this. I think the key thing that you see in his approach is that he's delivering on a campaign promise that we will take cybersecurity seriously and that we'll address this problem. And to do that, we need government and industry to work together.
IronNet, we were just talking about IronNet cybersecurity, does look to potentially government as potential clients. You yourself have the experience, having worked in the NSA. Were you privy to conversations as they work towards this draft? Is Donald Trump and the advisors looking to the private sector for advice?
They do. They reach out and give people, more than just me, people that can really read. They give them a chance to look at this and give advice. You know, I think that was one of the great privilege and honors to sit in there as one of the cyber listeners with the president and others and talk about it after the press left. I thought that was a great way to build on it. And you can see they're taking much of that input and others and continue to refine that executive order in a very thoughtful way.
Some of the other people he's looked to is the former mayor of New York, Giuliani. Does he have the sort of relevant expertise, do you think?
Well, I think what he's got is he's got the management and leadership insights of how do you bring industry and government together. And I think that's an important part of this. And so when you look at folks like Mayor Giuliani and you say, okay, what does he bring to the table? He can be one of the people that helps bring industry and government together. And I think that's as important as bringing technical folks like myself and others to talk about the actual problem.
Let's talk about the problem. Let's talk about Russia. And of course, all of this comes on the back of revelations that Russia was behind some cyber attacks in the run-up to the election. How concerned are you about relationships with the Trump administration and Russia, as others in government at the moment seem to be?
Well, I take a slightly different and probably unique view, but here's mine. When a new president comes into office, one of the things that we ought to do is say, is there a way that we can work with other nations? And if so, how do we do that? What's the right relationship that the United States should have with Russia, with China, with others? And can we do this in a peaceful way that helps the world? And so step one is research that, see what we can do. Can we come up with a relationship? Where are the limits to that? Find those limits and set this according to what his administration is going to do. You know, one of the things that I take great comfort in is some of the people he's brought in as a cabinet. You know, you look at the Secretary of State, you know, this is a great individual. And then Secretary of Defense, a personal friend, tremendous capabilities, and Secretary of Homeland Security. You put those three together, he's getting people that will give him candid advice. My experience inside that room once the press left, that's what he's seeking, candid advice. You know, it was amazing to see him go around the table, talk to people, get their insights, listen. You know what I thought is, that's the president our nation needs to see. He's listening, he's getting this right, he's going to build this up, he's going to address problems that we need addressed. And that's a good thing. And so going back to Russia, first step is we don't want to step out with well, let's go to a conflict. Is there a better way to do this? And if the answer is yes, we should have researched that first. And we should have discussed it, state to state and others.
But was the research too close? I mean, we've already had one person step down, Michael Flynn. The National Security Advisory team, therefore, in a bit of disarray at the moment. Can you talk to us about whether that's a weakness at the moment? Is that a worry? And also, what about who could fill Michael Flynn? Petraeus, one of them, who you also know.
I think they selected somebody already. I heard Bob Harwood. I think that broke the press. I think that's out there, so I'm not breaking it new, but that's what I heard. I know Bob. He worked closely with General Mattis. He was at CENTCOM at the same time. I know Bob from working there. He'll do a great job. You have other great people in this. You've got, KT McFarland, you've got Keith Kellogg and others. And then on the Homeland Security, you've got Tom Bossert. He's got great people there. And, the good part is he's reaching out and getting good talent. That's a good thing.
Could we see the relationship with Trump and some of the US Secret Services be impossibly damaged from some of what happened prior to him being a president? Do you think there's any vitriol or fight back coming from the Secret Service? Do you think that's being smoothed over?
I saw none of that. It was interesting. In the room that I was, you could say the same thing for Admiral Mike Rogers, the current director of NSA. I saw it, not at all. Completely professional. He outreached. I think the president's looking at these things. He's going to make statements, but at the end of the day, when I saw him reaching out to that in his discussions with Mike Rogers, one-on-one with the group there and with others, I don't see that happening.
Can you give us a global perspective of where is weak right now? Where is in need of greater cybersecurity, preventative measures? When you're looking at our net cybersecurity and you're getting potential calls, is US a key concern or actually not compared to the rest of the globe?
Well, I think the U.S. is, in part because we're a country, when you look at how do you attack the United States? Terrorism, cyber. If those are the two vectors, we've done a good job on blocking terrorism. We need to keep that up. That's a key for our future. A lot of work there. But our cyber defenses aren't there. We haven't fixed government. We don't have the government-industry partnership. An industry sector that's hit by cyber we would see after the fact in government. That's not where we need to be. It needs to be defensive. We need the ability to defend the nation at network speed so that if somebody tries to hurt us, we can stop it before the attack cripples us. And so those are the things where I see the biggest needs and things that we have to move forward on. It's those kind of things that, when I think about the greatest concern I have, it's when I look at that and you think, okay, this is where Secretary Gates and Panetta and others said, these are issues. We don't need a Pearl Harbor. The part that I found comforting was Trump listened to those things, President Trump did, and I think in saying that, okay, we're going to make steps. I don't know they'll get it all done this week, but I think they will address that, and I think you'll see movement on it. Now, we have to get industry and government to work together, and there's a lot of steps, but it starts with the first step.
Coming up, the Pentagon is paying hackers to test its key internal systems for any weaknesses. We'll hear from the so-called ethical hackers hired to carry out the bug bounties next. Plus, PayPal buys up Canada's TIO. We'll hear from PayPal's COO, the man responsible for Venmo. This is Bloomberg. Facebook is adding live games from Mexico's top soccer league to its growing streaming sports portfolio. Through a deal with Univision, the social network will broadcast 46 Mexican soccer or football league games starting Saturday and running through the playoffs. The commentary will be in English and Facebook streams will only be allowed in the United States. The financial terms of the agreement were not disclosed. And staying with sports broadcasts, AT&T and its DirecTV unit are being sued for alleged collusion with rivals in rights negotiations to show LA Dodgers baseball games. The accusation comes as regulators and politicians assess AT&T's planned $85 billion purchase of Time Warner, which would create a content distribution and production giant. AT&T has dismissed concerns the takeover would limit competition. It plans to fight the antitrust case. Now, US cybersecurity continues to be a major theme under President Trump, and with concerns about cyber vulnerabilities rising, the cyber firm Synack received a 3-year, $4 million contract to carry out bug bounties across the Pentagon. Synack's ethical hackers completed an exercise that ran through February 7th, with more expected down the road. We spoke with Synack CEO Jay Kaplan for more on what Synack's experiment found.
The Pentagon certainly recognizes that the threat is just as vast for government as it is for private enterprises, and they're realizing the only way to stay ahead of the ongoing threat is to utilize the same hackers that are attacking them almost every single day. They're using the hackers for their advantage. They're trying to get that adversarial perspective of what they look like when someone's trying to break into our most critical infrastructure, our most critical assets that really are running this nation. And it's really exciting to see them taking this more progressive approach, kind of like the technology companies have done for quite a few years. The banks jumped on board, the healthcare companies jumped on board, and now finally we see the government jumping into the same space.
And you're a man who had experience working there, the Department of Defense, NSA. Talk to us about your experience, and indeed, you've just run this exercise through February 7th. What did that bring up? I mean, was the Pentagon surprised by how many vulnerabilities it actually had?
Yeah, I think traditionally the government has taken a consultative approach. Let's bring in typical government integrators. Let's do assessments on our systems. Let's take reports in and try to remediate all the problems. The difference here, instead of 1 or 2 individuals, we've had 80 of the top hackers across the United States trying to break into a very critical system. This is the first time the government has ever attempted something like this on an internal sensitive asset. And within just a few hours, we found something pretty critical. It ended up on Secretary Mattis's desk within 24 hours, wow. And they've remediated the problem very, very quickly. This is a widely deployed system across our military organizations and branches across the government as a whole.
I mean, just looking at this screen that we've got up at the moment, cyber incidents versus federal investment, phenomenal growth in cyber threat. Not so much phenomenal growth in the price, in the amount of investment in cyber attacks coming from the government. Are they starting to wise up?
It's scary, and I think the government is starting to recognize they need to be thinking outside of the box. They need to be taking these more progressively leaning solutions, or they're never going to stay ahead of this threat. Look, we have a massive supply and demand problem as it relates to cybersecurity jobs. Over 1 million jobs currently remain unfilled globally, and that's going to skyrocket to 1.5 million jobs by 2019. There's no way we're going to hire all of this talent, so by utilizing more of these crowdsourced approaches, it's really the only way we're going to stay ahead.
Talking of the global aspect of this, I was interested, you say you had one of 80 of the top ethical hackers in the United States. Are you looking to ethical hackers outside of the US, though? Because this is where a lot of the cyber attacks are coming from.
So we do leverage hackers all over the world. We're in 40 different countries, and we utilize them for our enterprise-focused customers. The US government obviously is a little bit more sensitive to leveraging people in Russia and China, Eastern Europe, and so forth. But we do expect them to expand that scope over time. When they get more comfortable with this concept, we think that they're going to be comfortable with the idea of bringing more and more people outside of the boundaries of the United States, starting with our Five Eyes allied nations, New Zealand, Australia, Canada, and the UK, and then hopefully expanding from there.
We saw that graphic of how much cyber threats have increased, particularly under what are the first few weeks of Donald Trump's presidency. Is it just that the media has got excited about it, it's caught our attention, or indeed the 1,512% growth in cyber threat curve since in the last 10 years, have they got real or more frequent and more damaging?
The threat is definitely increasing in velocity, but at the same time, we're doing a better job at actually spotting the attacks. And so I think the data is actually a little bit deceiving. We have better technology and better capability to figure out when are people actually attacking our networks and critical infrastructure and governments. And so because of that, the number looks like it's increasing, but when in reality, we've been attacked by other nation states, by other entities for a very, very long time. This is nothing new. It's just getting more sophisticated, and we're actually hearing about it more in the press, more than we ever have before.
That was Synact CEO Jay Kaplan. Coming up, we'll hear from the man who helps settle your debts. The creator of the payment app Venmo is PayPal COO Bill Reddy on PayPal's latest deal. And a reminder that all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out. It's at Bloomberg Tech TV, weekdays at 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. Back now to the Goldman Sachs Technology and Internet Conference in San Francisco. This week, PayPal announced plans to acquire TIO Networks. TIO is a leading bill payment processor. It processed more than $7 billion in consumer bill payments in fiscal 2016. Now, we caught up with the PayPal COO, Bill Reddy, who helped turn Venmo into a millennial favorite payments app.
TIO is a bill pay provider for the underserved. And really, PayPal from our very beginning has been a democratizer of money. And we really think a lot about how we democratize the management and movement of money around the world. And the underserved is a big part of how we think about bringing folks into that democratization. And TIO as a bill pay provider to the underserved, we think of bill pay as a critical service for those folks. It's also the underserved. We think about as a population of nearly or more than a third of the U.S. population, 2 billion plus people around the world that are underserved by traditional financial products, that we think we can give a pathway not only into financial inclusion, but also into the digital economy. And so we think about TIO as part of our broader vision around how we democratize the management and movement of money for consumers around the world.
So are you thinking about bringing consumers from TIO onto other PayPal products? What sort of ones would be easy to offer them right now?
Well, so with TIO, you can walk into a store with cash and make a bill payment to one of their 10,000 plus billers. You can do that at 65,000 locations around the U.S. We have similar products with PayPal, for example, like PayPal Cash that we announced a few months ago, where you can walk into a 7-Eleven, load money onto your PayPal account, and even though you may have not had a bank account or a card, all of a sudden you now have money in a PayPal account and you're part of the digital economy. You might not have been able to make e-commerce purchases before, but now you can walk into a 7-Eleven, load cash onto that, and with PayPal, you're now part of the digital economy. We think this acquisition serves a similar customer segment that we can give access to a broader set of digital products as well. It
sort of screams to me that I think of underserved, unbanked, I think of the emerging markets as well. How does this fit into the internationalization of PayPal? Yeah, so we think about that, we're in nearly 200 markets around the world, nearly 200 million consumers around the world, and 2 billion plus consumers are considered underserved worldwide. And so we think about ways we can serve those folks and bring them into the digital economy, give them access to financial inclusion. Zoom that we acquired 18 months or so ago also has an international play, does international remittances, oftentimes serving the underserved. Bill pay is one of the things that Zoom provides to those folks. And so we think of this as a great complement to what we're doing with Zoom and what we're doing with access for the underserved worldwide. I mean, of course, you joined PayPal via an acquisition. You had brought Braintree, brought Venmo into the larger hub.
That's right.
What is the mindset of PayPal about acquisitions at the moment? Is it, you talk about the underserved, the unbanked, is it only that area that you want to make acquisitions? Where else could you be building up?
Well, I think, we've obviously had a huge focus in mobile. We did more than $100 billion in mobile volume last year. That's part of Braintree and Venmo coming in. And we think that there is a huge move to consumers moving to mobile as their primary computing device. Those are areas that are really interesting to us and where we've led the way and want to continue to push. We think about financial inclusion for both consumers and merchants as really interesting to us, and so those are places we'll continue to have a lot of focus. And we've had a number of great acquisitions, and we've also looked to go build organically in great ways. We did 11 plus strategic partnerships just in the course of sort of the last year or so, and that included not only Visa and MasterCard and traditional banks where we're partnering to bring services there, but also folks like Facebook, where we're a key payment provider inside of Facebook, and Google with Google Play, and a number of other technology partners that we're working with. So we're really bringing that sort of startup spirit and innovative mindset, both through acquisition as well as inside the company itself, to go really, really drive forward on mobile financial inclusion and partnering with the broader ecosystem to drive those things forward.
That was quite a change of tack when you got into bed with Visa and MasterCard. How is that coming to fruition? Because many feel, dare I say it, that PayPal was leading the charge years ago and it dropped the ball. It let other companies get ahead of it within the fintech space. Does the Visa and MasterCard agreement help win back some of that race?
Well, I think, PayPal's always been one of, by every objective measure, one of the most successful fintech companies, over the last 20 years. I think the partnership with Visa and MasterCard really, is a demonstration of how our interests are pretty aligned with the rest of the ecosystem. We have always really pushed for the digitization of cash and brought a lot of volume to players like Visa and MasterCard and issuing banks and those types of players. And historically, there were some places where maybe we weren't working so closely on those things, but broadly, we've always had a common interest around fighting cash as the common enemy and bringing that into the digital world. And I think we've led the way on that, and partnering with folks like Visa and MasterCard and issuing banks lets us do even more of that.
And staying at the Goldman Sachs Technology and Internet Conference, we also spoke with a member of the so-called PayPal Mafia, who now heads a company called Affirm. It's Max Levchin. Take a listen.
By growing as quickly as we have been, the road is shaping up nicely. But we're not particularly focused on measuring ourselves up to any one particular giant. We're much more excited about creating value for our customers, our merchant partners, our partners in the financial industry. Yeah. But I think the big trend in fintech has been a wrong one, where companies, not us, but many companies walk out and say, everyone here is a bunch of idiots. We're just not going to be anything like you guys. And that's just wrong. American financial system is probably the single best one in the world. And being a member of the club is an essential part of our plan and anybody who wants to be around for the long term. So I don't think I need to jump into being a giant, but I want to grow my way into the club.
Talk to us about that growth, because at the moment it's retail-specific consumer credit. What products will you be looking to next?
I think we're very much focused on our consumer credit view of the world. We are excited about bringing out a bunch of really new, interesting flavors of our product fairly soon, but we have a couple of completely brand new things that we're working on, which I'm always loath to pre-announce. I'm afraid I have to keep them for the launch as secrets, but I think delivering value directly to the customer is something that we're very excited about. So at some point, we will create things that speak directly to our customers.
You say the US is the single best economy in terms of its banking. What about the regulation then? We're looking at perhaps the regulatory environment becoming easier, quote unquote, for some of the banks if the Dodd-Frank Act isn't changed in some way. Is this a net positive, a net negative?
I think very much depends on the outcome of the changes. So much of the rhetoric around regulation stifling innovation is not untrue. In other words, I happen to agree that loosening some of the really tight grips that we have put on the industry right after the 2008 crisis, it's been a while. I think we can start being a little bit more open about, for example, rules around lending, but a fair amount of what was put into Dodd-Frank is as true as it was then today. And so just throwing it all out wholesale is also a mistake. So I think it's a little bit more nuanced than regulation, good regulation, bad. Regulation is important, it's necessary. Market does not always correct itself quickly enough, despite being a free market capitalist. I happen to believe in the need for regulation. So it's important to engage with the regulators as they reshape the rules right now.
Is it important to engage with the new administration as well?
I think so. I think it is important to engage with a democracy if you believe in a democracy. I think sticking your head in the sand and saying, I just don't like what happens in Washington anymore, is foolish. I think as business leaders, as citizens, we have a responsibility to be part of the conversation, not run away from it.
And that does it for this edition of The Best of Bloomberg Technology. We'll bring you all the latest in tech throughout the week. Tune in on Thursday for our conversation with Vinod Khosla of Khosla Ventures. And each day at 5 p.m. New York, 2 p.m. San Francisco, and 6 a.m. in Hong Kong. That's all for now. This is Bloomberg.